Doug, thanks again for being here with us when we talk about qualified retirement plans and some of the basic concepts that run through most retirement plans. When I get asked by my clients about starting a retirement plan, I want to make sure I convey to my business owners in essence, the gravity of what they're dealing with, the long-term implications. I often use the analogy, it's kind of like having a baby. You're going to be dealing with all kinds of levels of responsibility and financial costs for years to come. And it might be somewhat of a thankless operation at sometimes. It certainly can expose you to liabilities that you didn't foresee. Do you think that's a fair analogy?
That's a pretty good analogy, actually. An employer will need to devote a substantial amount of time and money when taking on the responsibilities of a retirement plan. They just won't need to change any diapers, hopefully. But other than the diapers, it might be easier to have a baby than a retirement plan.
Okay.
The big difference between having a baby and having a retirement plan is that there is much more reporting and disclosure that goes on with a retirement plan. And an employer has to learn a lot more rules and definitions than having a kid. Instead of educating your child, it's the employer who ends up needing a lot of education about retirement plans.
Yes.
But just like having a kid, an employer is fiduciarily responsible for the retirement plan.
That's an important word, isn't it? And I don't think most average Americans understand what that word fiduciary means. Why don't you spend a few minutes going through what it really means to be a fiduciary and the levels of responsibility that entails?
A plan fiduciary is a pretty technical term. And as a result, the term goes beyond just what a fiduciary is and encompasses what a fiduciary's duties are and what transactions are prohibited. Let's take a look at what the government says about fiduciaries. I have it over here. A fiduciary is anyone who exercises any discretionary authority or discretionary control over the management of the plan, exercises any authority or control with respect to management or disposition of the plan's assets, has any discretionary authority or discretionary responsibility over the administration of the plan, gives investment advice to the plan for a fee or other direct or indirect compensation, or has the authority or responsibility to do so. Thus, fiduciaries may include, but aren't limited to, the plan's trustees, investment manager, administrator, administrative committee, and the plan sponsor. But the duties of a fiduciary are just as important. A plan fiduciary must follow the plan documents, unless they're somehow inconsistent with ERISA, and act solely in the interest of the plan participants and their beneficiaries for the exclusive purpose of providing benefits to them. In addition, a plan fiduciary must act with the care, skill, prudence, and diligence that a prudent person would exercise under similar circumstances. Fiduciaries must also make sure the plan investments are diversified, unless it's prudent to do otherwise, and pay only reasonable plan expenses. There are also certain transactions that fiduciaries are prohibited from engaging in between the plan and the employer. Examples like lending money, extending credit, and leasing property. Of course, some transactions are necessary or essential for the plan's ongoing operations. These include things that may include hiring service providers and things like that. So in the end, one of the big consequences of breaking any of the rules of being a fiduciary is that fiduciaries are personally liable to restore the plan to the condition it was in before the breach. Any losses of the plan would have to be paid, and any profits made for self-dealing would have to be returned. So in the end, there are many items that encompass a plan fiduciary, not just one definition.
Doug, can you give us a little bit better context for the definitions that we're dealing with? For example, the first one, what's the difference between an employer and a plan sponsor?
Well, an employer and plan sponsor are often the same, if not almost always the same.
Okay.
This is especially true when an employer sets up the retirement plan and takes on the responsibility of funding and overseeing the plan. An employer can still be a plan sponsor, even if the employer hires a plan administrator to oversee the particulars of the plan. In other words, the employer is most often a plan sponsor because, well, they're sponsoring the plan.
It gets a little confusing in some of the terminology when they talk about a plan administrator or a record keeper or the third party administrator, or then the really technical term of the 316 fiduciary.
Okay, Ed, that's a little bit of a trick question.
Okay.
These three titles are pretty much the same with some nuances.
Okay.
As I mentioned, a plan administrator is often hired by an employer to effectively administer the retirement plan. The employer is still a plan sponsor, but now have a plan administrator. So that's called a third party administrator, and that's someone hired by the employer or plan sponsor. Now, to go a little further, a 316 fiduciary is more than just being a plan administrator. This is actually a service provider that does plan administration who agrees to take on fiduciary liability for their administrative duties. Some of these administrators even take on the filing of the annual Form 5500 required by ERISA. So those are the sort of the nuanced differences.
Okay, thank you. How about on the investment side? There's the terms of financial advisor, and then there's also a 321 fiduciary and a 338 fiduciary.
Well, the term financial advisor is a catch-all phrase for financial professionals filling a number of different roles and performing a number of different tasks. Really, anyone can call themselves a financial advisor. Some do.
And many do. Yeah.
Yes, that's right. Some have certifications, but many do not. Many retirement plans have financial advisors. When I served as counsel to the Western Groves Pension Plan, there were several firms providing financial advice. They don't usually handle the money, and they have no fiduciary liability for making stupid financial decisions. The Section 321 of ERISA generally defines an ERISA fiduciary as someone who exercises any discretionary authority or control regarding the management of an employee benefit plan or the disposition of its assets. So that is where you start to become a fiduciary. And now a 338 fiduciary is even more specific. An advisor who renders discretionary investment advice to an employee benefit plan is defined as an investment manager in Section 338 of ERISA.
Okay.
And an investment manager is someone who has the power to manage, acquire, or dispose of any asset of the plan and has acknowledged in writing that they are a fiduciary with respect to the plan. Thus, while a Section 321 investment fiduciary recommends investments and investment strategies to plan fiduciaries who either approve or reject them, an investment manager is authorized to implement those recommendations and strategies without the approval of the other plan fiduciaries.
Okay.
So there's your difference.
Thank you so much. There's a set of terms that I'm sure you're very familiar with, and that's the plan document and summary plan description. I think to some employers, that's still kind of gobbledygook. What's the difference between that? It's all paperwork, right?
Yeah, well, that is an easy one, really. The plan document is what lawyers like to write. It has all the legal language of the plan, and it is what is the governing document of the plan. Okay. So the governing document is what the actual plan document is. The summary plan description is the plan document put into plain English. It should be understandable by all who read it, but in all intents and purposes, the plan document is still the governing document.
Okay. So the summary plan description is what you typically would distribute to employees and
Right.
only in a legal circumstance would that employee's attorney probably ask for a copy of the plan document.
Yeah, and people can always get a copy of the plan document. Any employee could. It's just that it's the legalese part. Congress decided to require the summary plan description because so many people couldn't really understand the plan document, which makes
Gotcha.
sense.
There's a couple other terms that you find close to those sometimes when you're looking at the DOL materials. There's the summary annual report and a summary of material modifications. Do you want to give our audience a little insight into those?
Right, right. They're two entirely different things. A summary annual report is a one-page summary of the Form 5500 that's required to be filed annually by ERISA. Almost all of the information in the summary annual report will come from the 5500.
Yeah.
The summary of material modifications is a notice that is provided by plan administrators to inform plan participants of any material changes to the plan or the summary plan description. The plan administrator should distribute the, as we call it, the SMM, to plan participants within 210 days after the end of the plan year in which the material change was adopted. But if any material changes to the plan or SPD reduces the benefits or services within the plan, a summary of material reduction must be provided by plan administrators to inform plan participants of those plan changes no later than 60 days after the material reduction was adopted. So those are some of the specifics of what can occur once you get involved in providing a pension plan on your own.
Yes. What would you say have been some of the most common mistakes that employers have tripped themselves over when they've been trying to set up a retirement plan for their employees?
Well, I would say the first and last one is not getting professional help to set up the plan. Okay. Believe me, this is not something an employer should do on their own. The company or the plan sponsor also, there's times where the company plan or plan sponsor doesn't understand the detailed provisions of the plan document. And as a result, the plan operations aren't implemented correctly. That's another issue that can come up. And another problem is that errors occasionally occur because the plan document doesn't properly reflect the intentions of the plan sponsor. These errors generally occur during plan amendments and complete document restatements. That's something that might come up before and after putting a plan together, like when an improper box is checked or the adoption agreement isn't put in right. Some of these things can be pretty complex, and overly complex plan specifications create confusion and administrative burden. The contribution costs you're trying to save by electing certain provisions can be lost, and you'll have to correct these by formally amending the plan. So really, the first and last thing is to get someone who is very well qualified to help set up the plan and use them.
It probably doesn't hurt to have somebody double check their work. You know, maybe have multiple advisors making sure all the boxes are checked and kind of proofreading before anybody just moves forward with a program.
Yes, yeah.
What would you say about on an ongoing basis? Are there any things that 4 or 5, 10 years into it become even more of a tripping stone in a pathway for an employer?
Failure to maintain the plan documentation. This is one of the biggest mistakes. Also, there's a failure to implement the plan's automatic enrollment provisions. The employer's human resources department may not have a clear understanding of the retirement plan's eligibility conditions and forget to enroll an employee when eligible.
Somebody's new in HR and didn't realize that it was their responsibility to take the new employees in at the timely manner.
Yeah, and often HR is not really well trained in terms of implementing these retirement plans. Some retirement plans permit participants to take out loans and
Yes.
or receive hardship withdrawals from the participant's account. The plan administrator often forgets to properly track these loans.
Hmm.
But there are lots more problems that can come up, and they can mostly be avoided by hiring a third-party administrator rather than trying to do this all on the employer's self.
What have you seen? Any kind of worst case scenarios? Any memorable situations that you've run up against in the retirement plan world where it's just worth noting that make sure that this is something everybody can learn from, as opposed to anybody else having that same kind of issue befall them?
Right, right. The usually the worst case scenario involves an improper or no testing of 401k non-discrimination rules.
Hmm.
These non-discrimination rules were written with large companies in mind. Small and medium-sized businesses often find non-discrimination testing stressful and difficult to pass. Their challenges often stem from having a relatively high number of highly compensated employees. Of course, that affects the overall non-discrimination test.
Yeah.
In the case of family-owned businesses, high proportions of key family employees can, pose a similar problem. And if a plan fails to pass the test, the plan has 2.5 months after the end of the plan year being tested to correct excess contributions. The plan can distribute excess contributions anytime during the 12-month period. But if corrections are not made before the end of the 12-month correction period, there is no longer a qualified plan, and the entire plan may lose its tax qualified status.
Have you ever had an employer that you've had to deal with that fell into that really big chasm of losing the qualified status of their employee, their retirement plan?
Most of the ones we've caught in time, the real thing is to be proactive, to actually make sure in this worst case scenario that employees of the employer are advised what can be created with a non-discrimination. And in fact, probably when establishing the plan to begin with, it's smart to go through non-discrimination testing.
Yeah. Advise all your highly compensated that, yes, this is what we think you're going to be able to set aside. But it's possible at the end of the year, we're going to have to push back, not claw back, but push back to you some of this income in a taxable way because we can't get it past the ADP and ACP tests.
Right, right.
The one thing I'd like to kind of wrap things up with is some new legislation was passed at the end of 2019, the Secure Act. And it came up, especially with the 401k field, with some new kind of paradigms for how employers might be able to deal with all this administrative burden and additional costs. They're talking now about multiple employer plans and pooled employer plans and group of plans. That terminology is relatively new, and I'd like you to give us some insights as to what that might all mean.
Sure. Multiple employer plans have always been available. The problem is that under current rules, however, there are significant hurdles to achieving these benefits. To fully enjoy the benefits of a multi-employer plan or MEP, participating employers must demonstrate a commonality of interest.
Okay.
That is, they must be in the same industry or geographical area or join a plan sponsored by a qualifying association or professional employer organization.
Okay.
These closed MEPs are treated for annual reporting purposes as to be, all together. So all you do is put in one 5,500. But another disadvantage of the MEPs is the one bad apple rule, under which one participating employer's compliance failure can jeopardize the entire MEP's tax qualified status. That's
could be a problem.
Yeah, it's always been a problem because, I mean, as they said, if there's one bad apple, it just might mess up everybody else. So what Congress did is they enacted this legislation that allowed what are called pooled employer plans, which really is an MEP, but now it allows employers to participate in retirement saving vehicles that are not sponsored by each individual employer, but are instead sponsored by a third-party entity. So, for instance, a group of employers can get together and save time and money with one plan document, one annual Form 5500 filing, and one annual plan audit. They don't have to be in the same group of employers. They don't have to be geographically similar. Any of those things don't apply. And also, the PEP's tax status will not be jeopardized by a participating employer's compliance failure, so long as the plan documents are set up to contain specific procedures for dealing with such failures.
Gotcha.
PEP provisions are effective for plan years beginning after December 31st, 2020. So they aren't really in effect
Not there
quite yet.
Okay.
But it might be a good idea to start planning and see if you can get a group together if that's what you want to do. Now, group plans, not that familiar with, but they allow one financial services company to save on the cost of one single retirement plan for one employer. I guess you put a group together and you use one financial services company. But certainly the big change is the PEP.
Okay. Is there anything else that you'd like to add before we wrap up this session on the basics of qualified retirement plans?
No, I think we've covered a lot and probably put a lot of people to sleep. But
well, I think you've covered some excellent points, and I think it's important for any employer that really wants to go the qualified retirement plan way, whether it's a 401k or some other structure. They understand that the depth of commitment they need to be making to it, because it really can come back to haunt them. Doing a good thing for their employees does have some real potential downsides to it if it's not kept up and done the right way.
Right, absolutely.
Well, again, thanks for your time. We'll be looking forward to seeing more of you in some of the other videos.
Sounds good. Thank you.
Thanks, Doug.